Let's start with the recent global market sell-off. It was triggered by worse than expected job data and shrinking manufacturing activity in the U.S., and it led to almost a 12.5% drop in Japan's Nikkei and significant declines in the Nasdaq and the S&P 500. We're seeing some recovery today, but with the VIX index spiking above 60, we had $6.5 trillion erased from the global stock markets. Daniel, how do you see this volatility impacting the global economy in the near future? Are we on the brink of a prolonged downturn, or could this just be a correction followed by a recovery as we're seeing buyers slowly wade back into the market here?
Well, risk builds slowly and it happens fast, and we've seen it yet again. Okay, so I think that what is important now is to understand that a lot of the buying comes from investors that think that everything will be sorted out with a rate cut from the Federal Reserve. However, the market may need a lot more than a rate cut in order to regain its bullish trend, because it has been so inflated by central bank activity, has been driven by excessive government spending, by headline figures that were not really showing the reality of what consumers and manufacturers perceived, that ultimately it required only a relatively poor jobs figure and a couple of not so good but not bad earnings figures to drive a very significant sell-off. Therefore, buying just because there will be a rate cut may be quite aggressive in thinking, because the economy is slowing down. The earnings growth is not as robust as people expected and as markets required in order to justify current valuations. And at the same time, central banks are caught between a rock and a hard place. They have to decide whether they're going to combat inflation or maintain the elevated valuations of stock markets and bonds. It's a very difficult situation. So I think that it might be a temporary correction. But the problem is not just the correction. The problem is, what does it take for the market to get into yet another trend of bullish signals? And that is more complicated.
Yeah, well, let's open up the complication. I mean, this morning I was creeping your Twitter page and I saw one tweet there, and you showed a chart about the global equity market, and you were talking about Japan and Europe. You said that they show no defensive qualities here and that a bigger rate cut is needed. Break that down. We'll show the tweet. Break that down. What is needed here for that bullish trend?
Well, if you think about it, the market so far in the first months of 2024 has been driven by expectations of disinflation with no signals of a hard landing. However, disinflation is taking a lot longer to happen. The levels of inflation, particularly core inflation, remain elevated, but the signals in the real economy are actually quite weak and getting weaker in an alarming way, as we saw with the jobs figure, but also with the ISM manufacturing, with the services sector, etc. So, first, Japan and Europe are always seen by investors as defensive because valuations are relatively more benign than US equities. However, what we have seen yet again in this correction is that when markets turn, then Europe and Japan don't show any of those defensive qualities that are expected to be there. Why? Because there's a lot of value traps, and because the challenges of the Japanese and the Euro area economies are even larger than those of the US economy. So ultimately, for an investor, it's very difficult to find, let's say, safe havens in equities. The level of correlation is very high. There's been too much investment into ETFs that have driven a very, I would say, optimistic and certainly complacent perception about volatility and market dynamics. And what probably is happening is that we're seeing a realignment of risk in a very quick mode in order to get back to more logical levels of valuations, both in the European and Japanese markets, but also in the United States.
Yeah, well, I mean, let's talk about history repeating itself. I mean, given the historical resilience of the markets, do you think that the sell-off that we saw is an overreaction, or is there a fundamental shift in the economic conditions like you talked about that's justifying this level of concern? I mean, historical data shows that the previous market crashes, like in 1987, it didn't really lead to a prolonged economic downturn. Could this be a similar reaction where the market overreacts initially but then recovers and stabilizes?
Certainly, but not because the macroeconomic conditions or the jobs figures or the real economy are actually strengthening or will actually strengthen in a positive way, but because what markets ultimately end up discounting is that central banks will inject even more liquidity. Ultimately, the reason why market valuations have risen above fundamentals and the reason why markets remain so complacent and optimistic despite challenging macroeconomic, geopolitical, and earnings elements is because what markets are actually looking at is the amount and the cost of money. And when they perceive that with the incredible level of deficit spending and the enormous level of fiscal stimulus that governments are implementing, particularly in the developed economies, that will inevitably lead to rising levels of debt, which will inevitably lead to more easing from central banks. It does not matter if Jerome Powell or Christine Lagarde say that they will be very rigorous about inflation and very rigorous about monetary policy, because investors are looking ahead and seeing that all of that massive deficit spending will be monetized one way or another. So coming back to your point, that is what ultimately makes markets go back to a bullish trend, because they're basically discounting monetary destruction. And monetary destruction in the forthcoming years is going to be unparalleled.
Yeah, you're not kidding. Okay, we're going to get into the U.S. debt because it is absolutely mind-boggling, and we'll get into a little bit more on that in a second. I just want to throw it back to the U.S. side just for a second because, despite these signs of economic slowdowns, we talked about that disappointing payroll data, shrinking manufacturing activity. Obviously, the Fed still decided to keep it, 5.25%, 5.5%. Critics are arguing that this delayed action could really create more instability here. But then we saw this rally in the S&P. So talk to me about the Fed. Is the approach prudent, or has it missed a crucial opportunity to stabilize the economy here?
I think that the Fed is, as I said before, caught between a rock and a hard place. On the one hand, it is looking at backward-looking data. GDP, jobs figures are past figures. They're the past. They don't say anything about the future. Actually, they tend not to look at leading indicators, which is something that has always amazed me. But more importantly, what I've always found amusing is that a monetary policy institution doesn't pay attention to monetary aggregates. And if you look at monetary aggregates, the constraint in money supply that has happened in the past years can lead to a significant impact on the real economy in the next quarters. Therefore, the Fed finds itself in a very difficult position because, on the one hand, it has been extremely accommodative. Remember that the Fed delayed the path of reduction of its balance sheet because sovereign bond yields, treasury yields, started to rise to uncomfortable levels. So they've also increased liquidity in order to bail out in a sort of way the commercial banks in the United States with significant difficulties. So those two things show us that they have, let's say, prioritized liquidity over inflation, and that the only real measure that they have used to combat inflation has been keeping rates elevated. What's the problem with that? The problem with that is that governments don't care about high rates because they continue to deficit spend. And if the cost of debt rises, it's going to mean more taxes and more spending in the future and more debt, and they will pass it to the next administration. But the entire burden of the policy normalization has fallen on families and small businesses. So the real impact on the economy comes with a very significant lag. The S&P 500, the Nasdaq, the headline GDP figures, PMIs are all measures that basically show what are the earnings and the level of confidence from very large corporations, but they don't show the level of business confidence from small businesses, and that actually leads to the challenges that we are seeing right now. Therefore, the Fed is going to find itself in a very challenging position. If it cut rates in September, it's going to recognize that the economy is in a much worse shape than they initially expected. And if they don't, the impact on small business and families will continue to be strong. I find it a very, very difficult job, to be fairly honest.
Yeah, it's crazy. And Daniel, with all this revised data coming from the Fed, it almost seems like they give us something. There's a little bit of momentum in the market. I mean, we started covering it this year with 6, 7 rate cuts priced in. Here we are. It's getting a little bit more urgent, and it still seems like the consumer is still powering the U.S. economy here.
Well, the consumer is powering the U.S. economy with elevated levels of debt. Credit card debt is an all-time highs, and that is very, very dangerous. And that is a big problem of headline GDP. People look at GDP and they say, hey, this is a very robust economy. The growth is actually higher than expected, and it's doing phenomenally. But if you look at the headline data and then adjust it for debt accumulation, both the level of government spending and the level of consumer spending are unsustainable. And that is the real problem, is that none of those things are things that you see discussed in the FOMC meeting minutes. The Federal Reserve looks at inflation, GDP, jobs, unemployment, and that's it. They don't, even looking at employment, they don't look at labor participation rate, they don't look at employment to population rate, and they don't look at real wage growth. 3 things that actually show that the labor market in the United States is much poorer than headlines suggest.
Mm-hmm. Yeah, Jerome Powell, the Fed's chairman, has kind of just spoken about this in the press conferences and said, you know, he's trying not to be political, can't really comment on too much, obviously, but he has somewhat indicated that this U.S. national debt is unsustainable. You know, it's surpassed about $35 trillion as of June, with a debt ratio to GDP of 122%. Daniel, how sustainable is the current level of U.S. debt, and what potentials does it pose to the future here?
Well, the first signal that it is not sustainable is the fact that the United States, having the world reserve currency and record level of oil production, has persistent and elevated inflation. Inflation is the evidence of the destruction of the purchasing power of the currency. So basically, the way in which the unsustainability of debt manifests itself is in that level of persistent inflation and in the weakening of the currency's purchasing power. But the fact that the level of deficit spending, according to the Congressional Budget Office, is basically not going to be changed in the next almost decade. The Congressional Budget Office expects a 2 trillion deficit rising to about 2.5 trillion to 2034. And that is with expectations of no recession and no economic crisis. So the level of debt is also showing its unsustainability in the fact that even with low interest rates and even with low cost of debt, the interest expense in the budget already surpasses the defense budget. So the slow process of entering into stagnation via debt accumulation. That is the problem that is burdening Japan and burdening the euro area right now, is on its way to be shown in the United States economy, which is obviously a much more dynamic and much more productive and much more strong economy than any of those comparables. But the burden of high government spending, high deficit spending, huge debt accumulation, etc., always leads to stagnation and obviously weakening of real wage growth and weakening of productivity.
Mm-hmm. You know, it's interesting. I mean, we got to be the devil's advocate here. I mean, obviously there's high debt levels and it's very concerning. Some argue that as long as that the economy continues to grow and interest rates remain low, that the debt's manageable. I mean, they kind of point towards post-World War II. You know, the U.S. had a debt to GDP ratio over 100%, but managed to reduce it through this sustained economic growth. Are we in a similar situation now, or are the current conditions just fundamentally different?
Oh, nothing to compare to the Second World War. After the Second World War, the government entered into a huge saving process. And it reduced government spending dramatically, obviously, but the two things were also important. The size of the government and the economy was very, very little. And again, I come back to the point. The government entered into a very, very aggressive level of reduction of expenditure and therefore surplus and reducing the debt. That is not something that, even with a change of administration, it's not a question of one type, it's not a political thing. The problem is mandatory spending. Mandatory spending in the budget is rising faster than economic growth and tax revenues. And so what you say would be true if the US economy was growing at 5.3%. But growing at 2%, that doesn't work. That works actually the opposite way. So the risk is actually falling into the trap that many economists are falling into, which is to say, hey, nothing has happened, therefore nothing will happen. This is basically like saying, hey, we haven't crashed yet, accelerate. And that is not a good idea. And it's not just not a good idea, is that we know how it ends. It's not that it's, oh my God, what a surprise. As we know how it ends. We know that Japan is in stagnation. It's been 3 decades in stagnation. We know that the euro area cannot grow despite chains of stimulus packages. And we know that the United States is following the same path.
All right. Speaking about economies that are facing significant challenge, we're talking about China, of course. You know, they have a massive real estate bubble. They have slowing growth. We've seen this market sell off. It's also raised concerns about China's economic stability here. How do you assess it? I mean, in your words, Daniel, well, what's going on in China? And more importantly, what are the potential global repercussions if the issues persist?
Well, on the one hand, China is showing the results of massive stimulus packages. The real estate bubble burst that it's living right now is the evidence of the excesses of the past. At least what we can say is that China is not trying to offset the impact of the real estate bubble with another bubble, i.e. with big white elephants or government spending plans, etc. However, the problem with China is that the real estate challenge is impossible to offset, as it has been done in other economies, with higher consumption and higher levels of personal indebtedness, because China entered this real estate challenge in a moment in which GDP per capita was very small. So it doesn't have the ability to offset a real estate and real estate and construction that actually weighted more than 20% of GDP. It cannot offset it with consumption technology and the green economy. So China is going to have to face quite a few challenges, as well as the polarization of the world, with an economy that is looking less abroad and more inward. It's very difficult to exchange the growth in investment and in consumption coming from the West, from Europe, and from the United States with new partners in Latin America or in the BRIC nations. No, so it's going to be a significant challenge, and it's going to take a few years in order to get to the levels of growth that it had in the past. But it is also, we have to say, on the positive side, that it will be the only economy in the past 5 decades that will go through a real estate challenge of that magnitude without entering into an economic recession.
Yeah, of course, that's because of the government involvement. You know, I keep reading how many times they're pivoting here in China. I mean, does Beijing have any idea of what to do with China's economy at this point?
I think that they have an idea. The problem is that it's never worked. They have an idea, which is that the level of opening of the Chinese economy that led to unprecedented levels of growth and improvements in wealth for citizens. They are trying to change it for a different model that is more interventionist and that is more driven toward looking at the economy inside instead of outside. Not an export-led economy, but an consumption-led economy. Unfortunately, it has never worked. And it's not going to work if they try to do it that way. The only way for China to recover the levels of growth that it had before is to open back to the West. It's impossible to offset the consumption and investment of the United States or the Euro area with the BRIC nations. It's mathematically impossible. Furthermore, it is impossible to reach the levels of GDP per capita of Japan or the Euro area or the United States by increasing interventionism in the economy. And government's intervention, particularly in technology, have been very negative for investment and for the development of the economy. So I think that the government needs to actually take 2 steps back and start to think what drove the phenomenal levels of growth and reduction of poverty and improvement of wealth in China, which was the opening of the economy, and revert the recent decisions to close it back.
Yeah, well, they're certainly being fluid with whatever movements that they kind of uncover here. Okay, well, we're going to pivot into BRICS. I got to talk to you about it. It's not very often we get a guest like you with so much insight. But before we do, obviously, it's been a big year for gold. We just talked about China, their central banks buying it, investors, consumers, even Costco selling out. How do you view gold's role in today's market here? Is it still a hedge against volatility? What are your thoughts?
Well, I think that what we have seen, particularly in the Black Monday and this recent turmoil in markets, shows why gold remains the asset that helps central banks and investors reduce volatility and maintain a certain level of value within their asset base when things get challenging. Central banks, particularly the Central Bank of China, the Central Bank of India, etc., have realized that years of having particularly large levels of foreign exchange reserves have not helped the stability in the central bank. And when they hold foreign exchange reserves, many people don't understand. They think that they own loads and loads of dollars or euros. No, what they hold is treasuries and sovereign bonds. No? So when we see that since 2022, and despite the recent uptick of bonds, the price of those bonds has remained lower than it was in 2021, then they are losing value in their asset base. And the only way in which they can really go to, in a sort of way, de-dollarize and improve the equilibrium of assets in their asset base is by increasing the the percentage of gold. So I think that for China, for India, for so many other central banks, purchasing gold is not just something that is a prudent way of adding stability to the asset base. It is also a warning that the level of monetary destruction and the level of printing money that we have seen in the past is going to continue in the future, and therefore they need to hold an asset that provides real stability, and that is gold.
Yeah, well said. How about on the consumer side? I mean, how much gold should investors have in their portfolios? Do you have any forecasts?
It depends on the appetite for volatility and the risk aversion of each investor. But I always say that you have to look at a portfolio, even if you're a retail investor, as if it was a living entity in which you have elements that are growing, fast growth companies, stocks, etc. You have elements that provide stability, and you have the elements that provide a defense. Many people, many investors, when they have a portfolio, they barely have any defense. And the only defense in a market in which the level of abrupt correlation is so huge, and the level of coordination between bets and concentration between bets is so high, the only asset that provides you real defense is gold. No, so a minimum of 20%, I think, is logical, because that is basically what allows you to look at times like corrections like the ones that we have seen, and look at opportunities to buy something. What drives people to panic is to have a portfolio that is fully comprised of very aggressive, beta-driven stocks that are very linked to the macroeconomic or the monetary cycle. You need to have something that gives you defense, and that is gold.
Yeah, and how do you bust through the noise? I mean, before we get into BRICS, I mean, there's just so much narrative in the market that it seems like it's almost narrative-based as opposed to fundamentally driven within the equity market. I mean, how do you bust through that noise? Are you just looking long picture here?
I tend to look at the long picture and forget about short-term news. And when you look at the long-term picture, it doesn't mean closing your eyes and praying. No, it means every long-term strategy, you can and you must follow it with short-term catalysts that prove that that strategy is being achieved. No, and that is the earnings profile, the balance sheet strengthening, and the growth in cash flow margins, etc. So ultimately, fundamentals are what matter. But one of the most important fundamentals that we must never forget is the quantity and the price of money, because that is what drives the weighted average cost of capital at which we are going to discount the cash flows of the companies that we analyze. So what I always say is you need to be thinking about the long term and monitoring that the long term is achieved with short-term catalysts, and forget about, let's say, news that grab a lot of headlines, but that not necessarily change the real trend of the market.
Yeah, Daniel, we touched base on it a little bit about BRICS. Let's talk about this increasing talk about de-dollarization. You know, obviously China, Russia pushing for alternatives to the US dollar for international trade. But how realistic is the threat of de-dollarization in the US economy and the global financial markets?
It is right now is almost, I would say, right now it's almost impossible. And it's almost impossible for one thing. A reserve currency is not decided by governments. It's decided by people. It's interesting because the thing that we tend to forget is that the monetary system is the most democratic of them all. No government can decide whether a currency can be used more or less in the market. It is decided by investors and by citizens that accept that currency as a reserve of value, means of payment, and as a unit of measure. And that only happens when those people perceive that there are independent institutions, legal and investor security. So without legal and investor security, independent institutions, a reserve of value, a unit of measure, and a globally accepted reserve of value, you cannot de-dollarize. The euro has not been able to de-dollarize the world. And it's not because the dollar is fantastic and is the best reserve of value in the world, is because the fiat monetary world is not a world in which currencies gain by being the best, but it's a world in which currencies gain by not being the worst, which is not the same. Which is not the same. So it's very, very difficult. I always ask this question when people tell me about de-dollarization. Do you really think that the citizens of China are going to accept a currency issued by Brazil, Russia, India, and their own government? No. The Chinese may want Brazil, Russia, and India to use the yuan more. That may be an option, but they will not accept monetary institutions that are built with partners that don't have legal and investor security. And they know it. The first ones that know it are themselves. So it's interesting that all these years that we have heard the words de-dollarization, what has actually happened globally is re-dollarization. In that process, what has happened is that the dollar has become more of the world reserve currency, and the euro has lost levels of confidence compared to the US dollar when it was, side by side, obviously a distant second to the US dollar. But you're not seeing basically people globally decide to change to another currency. Ultimately, for the very, very simple reason, you cannot have a world reserve currency that dethrones the dollar if you don't have, at the same time, complete open capital markets and complete open investor security. It's impossible.
We're seeing it just won't happen, you're saying. So, we're seeing obviously more trade being settled in RMB. We're seeing China trying to take place in that. Is it just then, more smoke than fire here? Is it because we've weaponized the US dollar with sanctions and things like that? Like, what's happening? What's really taking place?
I think that what's taking place is that we are living in a world that is moving to a more polarized world. So I think that China, which is very intelligent, when they talk about de-dollarization and when they talk about the BRICS, they're not talking about issuing a new currency that will be accepted by all of them. I think that their objective is to get more of those countries to use the RMB, is to use the local Chinese currency. That is a much more logical strategy from a global power that is seeing the polarization of the world and that sees that the global economy is moving back to the years prior to globalization, in which you had basically 2 or 3 superpowers. So I think that China is actually helping its position for its own currency. And I think that makes sense, because obviously China is about 18% of the global economy, but its currency is only used in 4% of the world trade. So there's plenty of capacity to strengthen its currency with its own trading partners. But what I don't see is China accepting that there will be a currency sort of co-managed with partners that are very fragile partners. Let's remember that. The BRICS may be a phenomenal acronym, but they are countries with completely different strategies and even completely different investor and institutional fabrics, no?
Mm-hmm. How much of these returns, how much of the volatility, I wonder how much of it is just diversification from investors, buying crypto, buying gold, trying to get out of that US dollar play and making sure that they have assets in other locations?
Well, obviously, if you look at the global market and you want to simplify it probably to the extreme, the global market is one single trade. Is short the US dollar, long whatever else you want. So once you understand that, and that it's very easy to understand why it's so difficult to de-dollarize. It's virtually impossible to offset the importance in terms of liquidity and in terms of market of the dollar with any other currency. Furthermore, it is interesting, exactly what you just said, is how investors are looking for any way to, let's say, hedge themselves against the inflation created by monetary destruction. So the inevitability of the loss of purchasing power of the US dollar, trying to offset it with gains in assets that will, let's say, provide a return higher than that of the loss of purchasing power of the US currency. So obviously that creates bullish trends and bearish trends. And what we see in these periods of correction is precisely the unwinding of many of those trades. And one of them is obviously the cryptocurrency one, of all those investors that fear that fiat currencies are just going to go one way, which is the destruction of purchasing power.
Yeah, well said. Okay, before I let you go, because Daniel, I know I'm keeping you longer than I promised, but I got to get to talking about this extreme inflation. I think about Argentina. Obviously, that economy is facing a severe contraction. The IMF's predicting 3.5% decline in 2024. Inflation remains high, but we're seeing some easing, better than most expected. What lessons can other emerging markets learn from Argentina's economic struggles and what they're doing to stabilize it?
Well, the first lesson is that once you open the can of worms of inflationism, all systems go. Is that it's very comfortable to start by saying, well, the central bank could start to monetize some of government debt. Well, the level of government spending is too high, so we need to print more currency. And you start to get used to that, and then you get to a level of inflation that has destroyed the Argentine economy. On the positive side is the element that when the new government arrived, Mr. Milei's government arrived, the level of monthly inflation in Argentina was 25%. In less than 6 months, it has brought it down to 4%. It is still a phenomenal level of inflation, but at least what we're seeing is that when you really want to reduce inflation, the only way in which you can do it is actually by curbing on government spending, reducing deficit spending, reducing commercial deficits, and starting to build back the reserves of the central bank. The lesson for most emerging markets is that once you start the inflationary trend, it's very, very difficult to stop. And obviously that there is no way ever in which you can reduce inflation to normal levels without an economic slump. That's why when Mr. Milei took power in Argentina, the first thing he said was, it's going to be tough. Because you cannot basically just say, oh, we're going to grow 4% and we're going to bring inflation down, especially because government spending was such a significant part of that GDP that inevitably you're going to get a contraction in the economy. But a contraction in the economy, if you think about it, when it has been driven by bloated government spending and huge deficits that were increasing the monetization of deficit and therefore destroying the purchasing power of the currency, making everyone poorer and making the economy even weaker, actually is not a bad thing. It's like basically stopping the bleeding in an area.
Yeah, I mean, it sparked significant controversy. Obviously, there's some arguments that it could lead to some short-term social inequality, dependence on the U.S. economy. But there's this long-term stability and growth here. I'm curious, what are your thoughts? I mean, how do you balance the risks and the benefits into Milei's approach? And can Argentina serve as a model for other, struggling economies here?
I think it's a model of what not to do, because the key thing is what is the destruction that has happened so far, no? And you mentioned one thing that I think is very important. A lot of economists say, look, these restrictive measures, this government budget cuts, these deficit spending cuts may increase inequality. Well, let me start by saying that what has destroyed equality in Argentina and destroyed wealth in Argentina has been constant monetization of enormous government spending. So we need to understand that inflationist policies, that these governments present themselves as the solution of the problem that they create. Governments spend massively in a currency that has decreasing value, and then they give you a subsidy in a currency that has even more decreasing value. So what has created inequality, what has created poverty, and what has created economic disaster in Argentina has been to sort of implement policies of enormous government spending and enormous alleged social policies that became profoundly antisocial. The worst thing that you could do is that, because inflation is the most, if there's a tax that is unfair, it's inflation. Because inflation, if you're rich and if you have dollars, you don't care. But if you're poor and they give you a subsidy in a currency that is constantly losing its purchasing power, you become poorer. So the problem of the policies implemented in Argentina for 70 years, that are also the policies implemented in Cuba, in Venezuela, etc., are that they paint themselves with a picture of allegedly social policies, but they're profoundly antisocial, because what they bring is everybody to be poorer and to become hostage clients to governments that basically just print a currency that is worthless and give you a subsidy that is worth nothing.
Yeah, Daniel, are we starting to, we've seen this push towards socialism, it seems, younger generations, people just wanting this equality. I think COVID-19 definitely had something to do with it. There was a lot of handouts. Are we at this place now in history where capitalism is going to prevail once again?
Well, capitalism always prevails because capitalism is not something that is set in stone. It evolves and it adapts. No, socialism doesn't. Socialism is the policy that assumes that the government has all the ability to generate any and every wealth and redistribute it, and that rights are eternal and that resources are plentiful, which is not true. No, so the problem, I think, is in the use of words. When I have this debate with students, a lot of people say, no, we like socialism. I say, what do you like about socialism? You like the confiscation of private property? No. You like the nationalization of industries and the nationalization of businesses? No. Okay, so what is it that you like about socialism? We like social policies. We like some support for healthcare, education, etc., etc. And I said, phenomenal. Those are capitalism elements. Those are capitalism elements. Those are not traits of socialism. If you go to socialist regimes all over the world, the level of support, social support for citizens is exceedingly poor, and the level of destruction of wealth via destruction of the money of the currency is enormous. So what I always say to them is that it's basically that people are being confused between social policies and socialism, which is a complete different thing. And it's very important that people understand that the government doesn't give you anything that it doesn't take prior from somebody else, either via debt, either via increase in taxes, or via the destruction of the purchasing power of the currency. So when they look at their salaries and they make less, I think it was Ronald Reagan who used to say that inflation is the price of the things that governments tell you are for free. That is the ultimate reality. Now, yeah, I think that basically capitalism has proven to be the only system that allows you to have social policies without destroying the economy.
Yeah, well, history speaks for itself. Daniel Lacalle will be speaking on September 12th at the Optimum Bank Virtual Banking Conference. For details on how you can register for this complimentary event, go to www.virtualbankingconference2024.com. Of course, Daniel Lacalle joining us from Spain. He's the chief economist at Tresos. Thanks, my friend. I could have spoken to you for hours, but I appreciate the time we are given.
An absolute pleasure. Thank you so much for inviting me.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.